Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 296 VideoCast podcast for the week ending June 19th, 2025. A lot of great stuff to cover today, but as always, family first, let's get down to it. Annabelle concluded her 10U swim season with remarkable achievements. She secured an impressive 11 number one national rankings this season, set 7 Novaquatics team records, broke 2 Southern California records in the 50 free and 50 back. That's all time, baby. Additionally, she achieved relay national records in both the long course and short course medley relay. Annabelle's birthday was this week. Since turning 11, she already leads the nation this season for 11-year-olds in the 200 IM, 400 free, and 100 back. Mimi had an incredible week as well, enjoying the experience of a lifetime. On her 13th birthday, water polo superstar and gold medalist Annie Espar from Team Spain arranged for Mimi to be the only guest at a closed scrimmage between the U.S. Olympic team and the Spanish Olympic team. After the game, Mimi met both the U.S. and Spanish Olympic coaches, got photos with both teams, and then Tara Prentice from the USA Olympic team arranged a birthday tunnel for Mimi. Mimi was given suits and caps as gifts and even received an invitation to come train with the Spanish team the next time she is in Barcelona. It was the best 13th birthday gift ever, and we are so grateful to Annie and Tara. So there's Annabelle opening some of her gifts this week. That's Annabelle at the pool after doing all those great things. That's underwater from the underwater cam. That's Father's Day. We celebrated that at Bayside in Newport. Great restaurant on the harbor there. That's me with Annabelle and Mimi. This was MAC Cosmetics over at Pacific City, by the way. Exciting, number one, that my daughter wanted to go in, and number two, that there were actually people in the store because Estee Lauder owns this brand. And I was asking Mimi, apparently it's getting hot on social media again, even for young people after being dead in the water for a while. So continue to do my channel checks. There was some of Mimi's birthday gifts. They're one day apart. This is me with my buddy Ralph. And by the way, I want to thank Matt over at Mesa Verde Country Club for hosting us on Tuesday. Unbelievable, ladies and gentlemen. I got my first ever eagle on number 4. It was a 510-yard par 5, hit driver, 5-iron, 20-foot putt. Absolutely unbelievable. I think it's the new Bridgestone balls. It must be the equipment, right? And then this weekend at the Huntington Club, shot my second ever 80. I still can't break 80, but I shot 80 again, 39.41. So I'm chipping away, ladies and gentlemen. I did not give up on my goal to break 80 and to become a high single-digit handicapper. The question is going to be timing. So really grateful to Matt over there at Mesa Verde for hosting us. Then let's see, what else do we have here? Got the gifts. Then we've got that's Mimi with Annie Espar from the Spanish Olympic team. That's the USA Olympic coach, Adam. Then more great photos. That's with Team Spain. That's us at the Brant, which is a great restaurant. My friend Kenny's a partial owner in Huntington Beach at Pacific City. Definitely check out the Brant. And then that is Team USA. So pretty exciting stuff. On to it. Want to thank Christian Dagger and the great Stuart Varney for having me on Fox Business this morning to talk the Fed, talk a couple picks, talk a couple names, talk a little bit of outlook. We're going to listen in here.
Remember, the markets are closed for the Juneteenth holiday. Dow's off 300, Nasdaq's down 200 points. Tom Hayes joins me now to check out the market, even though it's closed today. All right, Tom, Trump says that Jay Powell at the Fed should lower rates right now. Is he right?
He's not only right, he's been right every single step of the way, Stu, about too late Powell. So the good news is we're going to get 2 cuts this year, 64% chance starting in September. They'll probably set the table at Jackson Hole. The bad news is, in the meantime, we're paying 200 basis points above inflation in terms of our debt service, which equates to about $600 billion a year. Who pays that, Stu? We pay that as taxpayers. It's completely unnecessary. You know who else is getting hurt from this wrong-minded policy? The millennials. 72 million millennials are trying to start a house, a family formation. They can't do it at 7.25% 30-year fixed rate mortgage. Home builders can't take the risk with their capital at 7% and speculate that people are going to buy it. They'll just sit there in inventory. We need to come down 200 basis points. And President Trump has made the case. If he's right about his prediction that inflation is going up, he can always hike 25 basis points. It's much easier to quell inflation than to deal with deflation or unemployment by being too late.
Maybe this is a technical question, but the president wants 1 full percentage point drop in interest rates. If he did that, would the yield on the 10-year Treasury come down 1 full percentage point, 100 basis points? And would that lead to a drop in the mortgage rate of 1 full percentage point?
Well, they can issue short-term notes, so that can bring down financing costs. As far as the long end of the curve, Secretary Bessent is working on that with bank capital requirements this summer. They'll create a lot of demand for banks to hold treasuries once again. They can issue on the short end and do an operation twist type of situation where they buy in the long end of the curve, bring down 10-year yields, bring down 30-year fixed rate mortgages. And by the way, I don't know if Powell will be successful, but I do think Bessent will be successful in bringing down the 10-year yield, which is going to bring mortgage rates below 6% before the end of the year. And that's going to be a good thing, as well as the stablecoin demand for treasuries, the bill that was just passed yesterday, the Genius Act.
You brought 2 stock picks with you. We've got to get through them fast. First off, GXO Logistics, GXO.
Yes, this is a Brad Jacobs company. The last Brad Jacobs company I came to your audience with 2 months ago was QXO. It's up 65% in the last 2 months. This one we believe is just taking off. It's a worldwide logistics company. 2 catalysts. Number one, the CEO announced he was retiring several months back, so we're going to get an announcement of a new CEO. That's going to be a positive catalyst. And number 2, on June 25th, the CMA, the UK regulatory body, is going to rule on their Wincanton acquisition, whether or not they need to divest the grocery business. The grocery business is only 6% of the revenues of Wincanton. So once that is completed, they can integrate, get the cost synergies, generate over $800 million of EBITDA this year. We think the stock's going from 42 to over 60 before the end of the year. That's a good one. And the second one I got for you.
You've got 20 seconds because we're almost out of time. Albemarle, lithium miner.
Albemarle.
Go.
Lowest cost, one of the largest lithium producers, very cyclical business. Prices are in a trough state. This happens every 5 to 8 years. The story here is energy storage systems. The demand is going to go from 1.2 million metric tons to 3.2 million metric tons by 2030. Albemarle is best positioned, even with trough prices. They're cash flow positive, $3 billion of liquidity. This can be a double to triple over the next 3 to 4 years, Stu.
Well, that was 40 seconds, but we'll let you get away with it. Tom Hayes, thank you very much indeed. We'll see you again real soon.
And we're back. Then I want to thank Camilla Kilowan and Diego Laje for having me on CGTN America last night to talk Fed Day. We'll listen in here.
And joining us now to discuss the latest Fed rate decision is Thomas Hayes. He's founder, chairman, and managing member of Great Hill Capital. Welcome back to the show, Thomas. First off, I'd like to get your reaction to the decision. It was expected, but is the Fed getting it right?
I don't think they are. I think Powell has unintentionally put himself in the position of being a lame duck for the remainder of his term. I think you're going to see President Trump start to allude to the next Fed chair, which will create a shadow Fed situation, which is going to be a dovish Fed moving forward. And I think President Trump made a couple important points today. Number one is Powell is about 200 basis points too restrictive, meaning the Fed funds rate is about 200 basis points more than inflation. And that's going to catch up. And the concept of too late Powell, whether you love it or don't love it, President Trump has been right every single time. And I think this situation is going to be the case this time. That's the bad news. The good news is Powell was slightly more dovish. It originally looked as if the meeting was hawkish, but he did adjust language from the firming language to the adjustments language. And I would say one last thing, Diego, is that the Fed is supposed to be data dependent. And the whole meeting was about him predicting that inflation was going to go up because of tariffs, even though that simply was not the case in 2018. And I think President Trump has made the point in past appearances where he said, listen, why don't you just cut? And if you're right about inflation, you can always raise rates. He could always do a 25 or 50-point raise if inflation ticks up from tariffs. But if he's wrong, he's certainly going to be too late, and that is a risk to the economy. And somewhat reflected in the projections, they're still projecting 2 cuts towards the end of the year. If they're so sure about that, why don't they just go ahead with it?
Yeah, there was a lot of caution about the effect of tariffs during Powell's speech today and while he fielded journalists' questions. But GDP numbers have not been showing signs of tariffs impact so far. We also got some better data about dropping, sharply earlier this week. How trade uncertainty is shaping consumer spending right now?
Yeah, look, we saw consumer confidence was okay. The GDP now numbers look strong. We will not have 2 consecutive quarters of negative GDP growth. So all of that is constructive. But at the same time, you have 72 million millennials, the largest segment of our population now, who have had to delay their lives because of Jerome Powell. They cannot afford houses because mortgage rates are too high. And that's going to have knock-on effects for many generations to come if they don't move quickly. Again, the Fed is appointed to be data dependent. He is predicting, and he continued to predict, that inflation is going to go up. And he may be right, but if he's right, he can adjust. It's much easier to bring down inflation through rate cuts than to ward off deflation if you get it wrong and you're too late, because the cost of bringing the economy out of recession and the societal cost of unemployment is far too great, particularly when you have debt to GDP of 120%, and we're paying $600 billion more per year in interest than we need to be doing given the rate of inflation and given the rate of employment at the moment.
Yes, Thomas, but during his speaking this afternoon, Powell spoke about, when he addressed the real estate market, about first the rates and second about housing supply. And new home construction here in the U.S. fell in May to a 5-year low, with economists saying the housing sector is struggling to add overall economic growth this year. How do you look at that? Because that's a longer-term thing.
This is the unintended consequence of wrong-minded decisions by the Fed. Who's going to build a house when rates are 7.25 and risk capital and hope that it sells? I'm telling you, if rates come down below 30-year fix comes below 6%, in other words, if the Fed funds rate was at a reasonable level, the demand for housing would be unlimited. And you couple that with the current administration looking to deregulate. They're going to open 500-something thousand acres of federal land, by the way, most of which in metropolitan areas where there's demand for starter home construction. The only thing that's missing right now, the only one that's delaying everything, is our predictor-in-chief, Jay Powell, who is predicting what he thinks might happen to inflation. If he's so certain about his predictions, why doesn't he look at his real GDP expectations, which he cut down to 1.4% real GDP for 2025? If he believes in his predictions so much that he thinks real GDP is going to be 1.4%, he should have done 50 basis points today. So right now, it looks like he's getting away with it. Everything's good. GDP's okay. Earnings are okay. Employment looks okay. Mixed data on that front. But once it starts to turn the other way, it turns hard, and he has the runway right now to take action. He didn't take advantage of today. My sense is maybe he'll get 2 more months to get through it. He'll announce something at Jackson Hole or set the table for the next cut in September, and he'll probably squeak through and thread the needle okay. A few months too late, but he'll squeak through, and it will be okay. But there would have been no downside of doing it today other than saving taxpayers 3 months of excessive interest on our treasury.
We'll certainly speak again then. In the meantime, thank you, Thomas Hayes. Great having you.
Thank you, Diego.
Much more.
And we're back. And then on to the quotes of the week from Benjamin Graham. The intelligent investor is a realist who sells to optimists and buys from pessimists. Those of you who have been with me for a while know that this is what we do every single week. Warren Buffett, most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. This is critically important, ladies and gentlemen, and very different from, I can always tell from the Ask Me Anything questions each week who is new to the podcast, because they're asking questions about the stocks that are in the headlines that week. And the ones that have been around for 1, 2, 3 years, number one, they're cool as a cucumber because by now they're wealthy relative to where they were. And number two, they ask all the right questions. So I'm glad to see that value is getting delivered. Charlie Munger, great investing requires a lot of delayed gratification. That is the name of the game, ladies and gentlemen. By the way, delayed gratification also happens to be very tax efficient. So that's the name of the game. Let's talk about some of the data here. This is a concept that I've been focused on in some of my public appearances of late. Long-only funds, cyclical versus defensive positioning is very low versus history. So when we think about cyclicals, think consumer discretionary like the VF Corps, et cetera, energy, tech, industrials like the Generacs, like the Stanley Black & Deckers, materials like the Albemarle, tech like the Intels. We're going to talk about some developments there. Hedge funds are underweight cyclicals relative to defensives. You always want to take the other side of the trade where the boat is crowded. Relative positioning at historic lows, which means we're going to see rip your face off moves in these baskets, which we have great exposure to. US dollar, early stage secular bear market deterioration of the US government balance sheet, Fed policy credibility and independence, new catalyst for China, Europe, and Japan equities. This has been a theme for us. We came into the year talking weak dollar. Everyone thought we were crazy. It continues to persist. This is probably the most important data point of the week. And some of you are going to have a tough time understanding this one. And that's okay. Don't worry about it. I'll do my best to explain it. But what this chart is, it shows select growth and quality factors, percentage of respondents. This is the institutional manager survey, percentage of respondents using return on equity edged higher in 2024. So what you can see is the quote unquote value investor of yesteryear has been forced into this new framework, which basically means they've become closet indexers, and they have justified it by calling it quality or growth at a reasonable price, and it's masqueraded in the concept of return on equity, or more commonly, return on invested capital. Now, return on equity and return on invested capital are critically important variables. However, they tend to be emphasized more so as it relates to what they call quality or durable secular growers, which in effect has been MAG 7. It's just a code. It's a fancy way of saying I'm not a closet indexer, but when you look at my book, I've been basically bagged in the most crowded trades for a while. And if you look at the greatest value investors of all time, that made billions in the 70s when the stock market did nothing from 1968 to 1972, whether it was Buffett or Cooperman or Gabelli, kind of the value mafia I grew up with. No one is talking in those terms. No one is talking about the investing style of turnaround Tom that Buffett did when he was running his partnerships and shot the lights out before rolling his LPs into a permanent capital vehicle called Berkshire Hathaway. And the point that I'm making with this chart is that, and I was texting with a friend. I said, so these annotations are my own. The red being everyone now focused on quote unquote quality, return on equity, whereas these periods in green are cyclicals, value, and turnaround Tom type of stuff. And you can see the dramatic outperformance from 2001 to 2007. We've talked about that a lot. And then in the early 90s, also in the 80s, and then in a big way in the 70s. As a matter of fact, we've talked about it. Value has outperformed growth, including this aberrational ZERP period by 4% and change per year since 1927, including the last 10 years when we had zero interest rate policy, which means if you had invested $1 million in 1927 in value or growth, you would have $68 million more dollars if you chose value. So what I told my friend is another way to look at it is follows, quote, if I were looking in the rear view mirror, what would be the most important metric to be overweight? And what everyone is going to say is quality, high return on equity, secular grower, AKA code for Mag 7, what worked yesterday, the church of what worked yesterday. Now, much of the value, quote unquote, community is now singing from the same hymnal because they've been forced to in order to survive. Most don't do turnarounds well. They don't understand the framework and the formula that works. So the value traps that they had been in certainly didn't work. So they've kind of moved into being growth investors without admitting it and just closet indexing. We are taking the exact opposite tact and believe those who have overweight exposure to the green, cyclicals, value, turnarounds that are just starting to rock and roll following the once in 100-year situation created by COVID, will dramatically outperform the next 3 to 5 years. Even those who take the view that capital light has changed the game. So everyone that's now chasing what worked yesterday and focused on quality, secular growers, high return on invested capital, high return on equity, which over time is a good formula to have, except when everyone else is doing it, would be advised to at least hedge that view with solid green exposure in case the historical cycle proves to be recurrent. And I say in case to be gentle, when the historic recurrent cycle proves to come back. And it's already started to happen this year, as you saw, and which has been a core to our theme. International would outperform US, dollar would get weaker. Now you're going to start to see smalls outperform large, record short interest in small caps, cyclicals, turnarounds. We're already seeing these home runs, whether it's QXO, which is a cyclical, whether it's Comstock Resources, a cyclical, that's almost up 8 times 4. That's almost up 4 bags now, and on and on. So the game is just beginning here. So, you might feel like you missed it when you look at indices because all you're looking at is this, which is due to take a continued breather. And we've talked about Mag 7 trading back to the top of the range, but not more because their earnings growth is cut in half and their CapEx is going through the roof. The fortunes are going to continue to be made here for existing clients year to date. You know what I'm talking about, and so on. So leaving that aside, even if you're of the view chasing what everyone else is doing and calling it something else, you'd be very wise if you're a large capital allocator to hedge that bet and have someone who's exceptionally skilled, which is a dying breed, by the way, in these areas right here. I would say in 5 years, you're going to see a huge crowd get very interested in this area, but by then all the money will be made by people like me. So, and you. So that's the name of the game. Huge reversal in fund manager survey recession expectations in the last 2 months. Went from the tariffs to not the tariffs. So this weekend, maybe Trump drops a bunker bomb. Maybe he doesn't. Market's a little jittery, but we'll get through that. And we'll have an outcome by Monday for sure. FMS investors view corporate balance sheets as the best health since March of 2016. They've delevered. That's a good thing, just like household balance sheets had. Oh, and by the way, here's my beautiful hedge fund tips with Tom Hayes mug. Price is what you pay, value is what you get. Thanks for everyone sending in pictures. We got a new photo. Thanks just for sending it in. But the guy sent a picture of his cat. So I don't know if that counts, but we did post them up with some of the other photos we've already gotten in. When you place an order, and I think the golf shirts are back in, the t-shirts have been a big hit, obviously the hats and mugs, but send your picture to, we have so many orders and so few pictures. So stop being shy. If you want, just put a fake name or whatever and we'll post you. But we covered these last week. A lot of hats and t-shirts. So this is our latest from Don G, who is a cat reading The Intelligent Investor by Ben Graham and sitting next to his hedge fund tips hat. Best performing asset in the next 5 years. Fund manager survey says international stocks. Opinion follows trend. What a difference a half a year makes. Couldn't give away international when we were pounding the table. Now everyone wants it. It's just getting started, ladies and gentlemen. Asset quilt of total returns. MSCI EFA is up 18% year to date. Emerging markets up 13.9%. S&P up only 3%. REITs up 5%. Global high yield, cash, and commodities. So that's that. We've seen very few instances where gold is at the top of the range for more than 2 years. The last time that happened was 2010 to 2011. The next year it fell to third to the bottom. The following year after that, it had the absolute worst performance. So for everyone chasing gold up here, God help you. Investors on EPS and leverage, net percent of FMS investors think that global corporate profit growth will improve. That's coming off the lows, but it's at levels like you saw in COVID, like you saw in the tech wreck in 2022, and like you saw in the great financial crisis and the tech wreck of 2000, 2001. The sentiment is still subdued. Mid-cap ETFs accelerating in inflows. This is the theme, small and mid-cap starting to play. Just like you saw in 2001 to 2003, and then straight through outperformance to 2007. Lower financial leverage than 1990s and 2000s. You can look at the balance sheet. Here, we haven't had this low leverage since the mid-80s for corporate balance sheets. Global materials still dramatically underweight. That's where Albemarle, in a quasi-related sense, Comstock Resources, that's why you're starting to see huge moves there. Household holdings as equities as a percentage of total financial assets. This is U.S. equities, ladies and gentlemen. And honestly, we haven't had this highest percentage since 68. Market kind of topped out in 68 and certainly started to collapse from 72 to 74. 2000 and 2024. Now, you have to consider that top 10 stocks is still 40% of the S&P 500. So what this means is the overweight relative to everything else. Same thing in 2000. If you remember the magazine covers in 1999 saying, has Warren Buffett lost his touch? And Warren Buffett was buying Procter & Gamble. He was buying all these defensive stocks, staple stocks, boring stocks, industrial stocks at the top of the quote unquote market in 2000. And in 2001 and 2002, while the NASDAQ crashed 90, his stocks rocketed. So you're thinking like, well, if the market crashes, wouldn't everything crash? And the answer is no, when you have such a concentrated period, if you're in the right things. And that's why you need to hedge out with especially if you're a large allocator, with someone who is a specialist in the greens, unless you think this is going to be the exception where this doesn't revert to the mean and those top 10 weights, meaning 40%, don't underperform for the next handful of years. And our case is that they will, and they have, and you've seen it year to date. Even though they're bouncing back in the range, we had said that they will bounce back to the top of the range. And in aggregate, not overtake. If you take a mags versus, one stock, someone will say, well, what about Microsoft, or what about one of these that's making new highs? Yeah, there will be one or two, but you look at Tesla's still down, Google's still down, even Amazon, which is probably a buy. So you want to make massive amounts of money in the next 2 to 3 years, you need to find what's not in these percentages that are going to be at the effect of mean reversion. Bank of America Global Fund Manager Survey, investor sentiment improves slightly from May via bearish April level. Again, you see these levels only at the 2022 lows, the COVID lows, the first trade war, the EU debt crisis, great financial crisis, and 9/11. So for those who think that everyone's too bullish and therefore we're going to crash, they're absolutely incorrect. I think after we get through this Iran volatility, we're going to push to new highs before the end of summer, probably before the end of July. Bubbles, you can see past bubbles, ARK and Bitcoin, which is an interesting one that Bank of America points out here. You had smaller China in the late 2010s, or 2007 to 2009. That is going to recur, in our view, over the next 2 years. It'll be a final blow off for China, just like you had the final blow off for Japan in the late 80s. And we're going to benefit from that with BABA. Growth has underperformed value by 7 percentage points so far this year. That was also part of the theme. Value dispersion peaks usually precede value cycles. The cycles we talked about, what's the cycle? Is making sure you have a manager that's expert in these areas, because the value cycle is just beginning. And if you know what you're doing, it's literally like a treasure hunt every single day. Value trades well below historic average versus growth. You can see here, this is plus or minus 2 standard deviations. We're probably about halfway there. And then valuation strategies for information technology. Price to free cash flow outperformed the index the most over the last 40 years. And that's buying low price to free cash flow is the name of the game. Right now, that's not popular. That will come back it's already coming back. This year has been the inflection point. Large caps relative performance, total return of growth versus value. You can see here this extreme not seen since 2000, and then prior to that 1980, and we know what happened next. Value dramatically outperformed. S&P 500 increasingly top heavy. Again, top 10 largest S&P companies as a percentage of the S&P, almost 40%, 38%. This will revert. In 2000, it was 25%. You'll have your people come out and say, well, this time it's different, cap light, blah, blah, blah. I heard the same story about eyeballs in 1999. AI is certainly going to change the world just like the internet did. The question is, how much have you already paid for, and who are going to be the winners? And if you think you exactly know, it's what you don't know that you don't know. That can hurt you, and no one knows, and that's really what it comes down to. So you want to buy the beneficiaries that are beaten down, that are going to benefit from all this, while all the innovators get flushed out in the early cycle of changing the world, which happens every single cycle. Short interest has risen in 2025. That creates the next buyers, which is why I'm been pushing. We're going to new highs before the end of the summer. FMS investors are net 38% underweight U.S. equities, the most since May of 2023. This has hockey sticked since the beginning of the year. We called this on the podcast aggressively in the fourth quarter of last year. Go back and look at the tapes. More downside for dollar expected. Opinion follows trend. That's from Bloomberg. Economists raise China growth exports outlook for 2025. Composition of the $81 trillion global equity market. You can see here, US is 64%. The earnings power is nowhere near that percentage of the overall equity pie, and that will revert, and we've seen the beginnings of that this year. Long emerging markets, again, one standard deviation below the means. And the last times you got to this was 2000, 2001, which was you never made more money in a shorter period of time than being long emerging markets, small caps and value from 2001 to 2007. Everything's pointing to the same thing. Very similar. Why did you see a lot of these managers make billions in the 70s when the stock market did nothing? Small caps outperformed. It was a stock picker's paradise. Same thing's going to happen now. And by the way, same thing in the second term of Reagan in the late 80s from 85 to 90 and early part of Bush 1. Target rate probabilities for September 17th meeting up to 64% now. First cut, we covered that on Varney. AAII, bulls minus bears. Again, not at extreme. We push higher, ladies and gentlemen. 6 months later, on average, 10%. 1 year later, 21%. S&P 500, you can see here making an aggressive, what they call a cup and handle. Measured move would imply 4,900 to 6,000 is 1,100. Measured move would imply 7,100, probably by sometime in 2026. Yet another sign this is a bull market. After 2 months of gains in the S&P of 20% or more, 1950 to today, 1 year out on average up 30%, 6 months out on average 16%. Economists expect Germany to grow again this year. That is from negative earnings growth to positive earnings growth starting this year and reaccelerating in 2026, 2027. That helps the European theme. That helps our GXO position, which we talked about with Stu. By the way, I got some incredible news. I'm going to just skip to it right now. Literally, it must have been either while I was talking to Varney or shortly thereafter. GXO announces completion of the UK regulatory review of Wincanton acquisition and raises full year 2025 guidance. So this is what I said as one of the two catalysts for GXO to get to 60 before the end of the year, and probably more, by the way. Largest pure play contract logistics provider announced that the UK Competition and Markets CMA has cleared GXO's acquisition of Wincanton, subject to the divestment of a small number of Wincanton grocery contracts in the UK, which is probably less than 3% of total revenues of Wincanton. And that integration will be permitted with the vast majority of the Wincanton business once certain administrative conditions are met. The company also announced today that it is raising full year guidance on organic revenue growth, adjusted EBITDA, and adjusted diluted EPS. We are pleased with the regulatory review, excited to bring the two businesses together. Combination offering customers across the UK, Ireland, bring presence in strategic verticals that will serve as a springboard for growth. Well positioned to move forward swiftly and look forward to welcoming the Wincanton team to GXO. Updated full year guidance, organic revenue growth. The midpoint was brought up to 5% from 4.5% organic revenue growth. EBITDA midpoint from 850 to 870, so 20 more million of adjusted EBITDA. EPS midpoint 253 from 250, and free cash flow conversion to 30% mid-range. So all of this super exciting news, pretty timely for that interview this morning. Better to be lucky than to be good sometimes. So earnings of MSCI China continue to shoot upward. Compound annual growth rate over the next 7 years expected to be, let's see here, what are we talking about? Somewhere around 9-10%. US, with the implication being the value, intrinsic value of the businesses off of normalized value multiples would be double. Off of depressed multiples will probably be quadruple, FYI. So Goldman holdings in Chinese equities as a percentage of total AUM is 1.6%. The benchmark is 5%. Managers are 3.4% underweight Chinese equities. The catch-up is going to be violent to the upside. If you don't have it, can't help you. An overlooked boom in China, 15 major economies with the highest growth rate of household spending in this century. That game is back on. We're going to cover a couple of things about that. China's consumption gets a boost from trade in subsidies, household appliances and video equipment, furniture, communication appliance, automobiles, retail sales. This is called Alibaba is the toll taker. 40 cents of every retail dollar spent on e-commerce goes through Taobao Tmall. The government has committed to 70% internal consumption. And Baba is best positioned to take advantage of that, particularly the middle class. Temu and that garbage PDD got a share of the pie when people were poor during COVID and bought garbage. Now that the middle class is reemerging and getting their confidence back, Taobao, Tmall controls the middle class spend and is the preeminent toll taker. International stocks seen as the best asset class over the next 5 years. Opinion follows trend. It's amazing when you have 15% of outperformance. Goldman Sachs top-down S&P 500 forecast, 12 months out, 6,500. So that's opinion follows trend. They went down when the market went down. Now they're back up. They blow like in California now. I understand blowing like the wind, like a palm tree in the wind. That's most of the sell side. Earnings growth, and by the way, that's why they keep their jobs. If they were like an oak tree and they fought the wind, they would snap. These guys blow with the wind, so like a palm tree, they always bounce back and keep their jobs. Earnings growth, pro forma earnings year over year. You can see Unmagnificent 493 accelerating, Mag 7 collapsing. That's not new. We've covered that almost every week. China retail sales year on year re-accelerating like we haven't seen since 2022. And prior to that, 2020, when all the equities were off the charts. This game is just beginning. Retail flows have recently been stronger than average. And they've been right. Okay, by the way, they were buying the dip in COVID. International relative to the rest of the world stocks since 1950. So you can see here this concentration that's going to get smacked, already has this year. It's going to continue to get smacked when you have this concentration like you saw in 1968. And most people don't know that they're still stuck in this and they're all on one side of the boat about to get drowned because they think they own 500 stocks and they don't understand what a cap weighted index is relative to an equal weight. Relative to our exposure to a manager that specializes in the green area, which is looking through the windshield versus the rear view mirror. Median 2-week S&P 500 return since 1950. Second half of June. Okay, tends to be weak. We'll see what happens. GS social. I think we pulled forward a lot of the weakness that was supposed to happen in June and got it in April and May, but let's see. GS Social Media Economic Sentiment Index starting to move back up. FMS, most underweight the US dollar in 20 years. This goes all the way back to the early 2000s, which was when what happened? International outperformed, value outperformed, small caps outperformed. What do you know? Retail investors have been selling in the last 3 weeks. Every single consistent. Okay, well, it's something to keep an eye on. Household allocation to U.S. equities across global regions. U.S. has the most concentration, which means they're overweight those 7 stocks, which, by the way, the carry trade continues to unwind. We've warned you about that. And all that hot money is coming out of those 7 stocks. Underweight China, that will play catch up. More opinion follows trend. Stock market around breath thrusts, which we just had. 12 months later, on average, up 15.5%. So basically here we are. Here's where we have to go after this level of breath sauce for the technicians out there. Investor allocation to equities at an all-time high, which basically means still Mag 7 because of the weightings, even though the earnings growth is collapsing in those kind of call it 10 names. Central underweight debt, which is going to change now. The demand for treasuries is going up. Bowen and Besant are going to get the SLR intact probably in coming weeks. The Genius Act was passed yesterday. That'll create another $1 trillion of demand to $2 trillion of demand of treasuries over the next 2 years. The game is on. And then Trump will probably start to appoint or announce trial balloon names of new Fed chair. So that will act as what we call a shadow Fed chair. So Powell has effectively made himself a lame duck for the remainder of his term. Once Trump starts to announce very dovish names out there, the market will start to discount 100 to 200 basis points of immediate cuts that will come into play May of 2026. It'll start to discount it the third or fourth quarter of this year. So be on the lookout for that. Central bank cuts at fastest pace in 2025 last month. Everyone except for Powell. Too late, Powell. And that's that. He'll get away with it. He'll set the table in Jackson Hole. He'll do the first cut in September and probably second in December. And then he will be off to play congressional 5 days a week. I hear he's a pretty good golfer, by the way. S&P price to sales over time. Again, this is skewed by those 10 names. Decade worth of volatility in the 2020s. That's interesting. Wow, almost double the volatility of the 70s. The stories I heard about the 70s, that's pretty wild. Consumer balance sheet, very healthy. $190 trillion of assets, $20 trillion of liabilities. That's pretty damn healthy. Fed call as of 6/10/2025. There's a lot of room to lever up once they get the rates under control. Powell's just kind of delaying things, but it is what it is. Fed call as of 6/10. That's immaterial. Results from buying S&P on the last day of loss exceeds 12%. No one cares. Cumulative retail sales. January through May. Total short interest ticking up. So last time we saw short interest get this high was like the whole in 2016, and you had a monster rally the next couple of years. These guys are forced buyers. This amount of short interest the whole way up from 2022 higher, they just kept shorting and shorting and shorting. So now they're going to be forced buyers as this thing pushes to new highs. Huge move into Eurozone and emerging markets out of US and US dollar. We'd been calling for that for a while. Into the euro, into healthcare, by the way, into industrials, slowly out of tech, out of Japan, out of the US dollar. Record high foreign ownership of the US stock market, that's starting to decline. Underweight energy, we see it in the comm stocks. Christmas in July, NASDAQ's 12-day mid-year rally. So markets tend to have a massive rally in the first 12 trading days of July. You do not want to get short ahead of that. If you want to lighten up, do so after all-time highs sometime in August. But basically, it just grinds sideways till the end of year rally or net. Russell 1000 versus Russell 2000. This is large cap versus small cap. This is going to mean revert like nobody's business. We have not been at this level of an extreme since 2001. Hold on to your seatbelts. If you don't have small cap exposure, just, look, all this is opinion, not advice, but at least get yourself an ETF if you don't have a manager who can pick the best stocks for you. So click on terms here, opinion, not advice. Talk to your financial advisor before doing anything. Speaking of which, we are going to be opening up again for Q3. for the smaller accounts, the $1 million and above. So those of you who are interested in getting in queue for that and having a conversation so you can be ready to go July 1st, go to Hedge Fund Tips, click on Money Management, and we'll have a chat. This is not a solicitation. All this is opinion, not advice. Do whatever you want. Check with your financial advisor first. Bloomberg Trade Policy Index, S&P year-to-date, trade policy uncertainty. So that's getting more certain. Companies that reduce shares at low valuations tend to outperform annualized performance 1986 to 2025. The greatest example of this under the sun is what Alibaba did buying back stock between $60 and $80. I mean, they couldn't have done any better. I'd say another one that did a good job was Tencent. It's amazing, these Chinese companies, they were smart enough to have cash reserves, and they were twice as smart to deploy them in the hole when everyone was ducked under the desk. And now these stocks are up 100% and not even starting to move yet. The beginning of their moves is just now. But they did the exact right thing. You rarely see that with U.S. managers. What you see with U.S. managers, unfortunately, is after the stock has had a huge run, 4x, 5x, they start buying back stocks so they can sell their ESOP plans into the liquidity created by the company, which is, a crime. It's not a literal crime, it's a figurative crime, and it's ripping you off as owners, but it is what it is. Companies that reduce shares at low, valuation matters. It just didn't for the 2010s. So if you go back, EBITDA to enterprise value dramatically outperformed from 86 to 2006. We've been through this. And that's that on the data front. So a lot of great stuff there. Some headlines. China's May retail sales grow at fastest pace since December 2023 as subsidies help boost consumption. Alibaba, how you doing? So let me repeat that. China's May retail sales grow at fastest pace since December 2023. Retail sales jumped 6.4% from a year earlier, sharply beating analyst estimates for 5% growth and accelerating from the 5.1. What they underestimate is the ability of a basically unelected official who has unlimited runway to affect policy change quickly and massively, which you can't do in a democracy where people get voted out of office every 2 years. So when they said they are driving internal consumption, believe them. And then all you have to do is reverse engineer who's going to be the biggest beneficiary. And it's unquestionably Alibaba. So that's the name of the game, just beginning. China to loosen IPO restrictions by reinstating listings of unprofitable startups. That's the CSRC, more IPOs. Game on. Beijing's reform could bring Hong Kong listed Alibaba and Tencent to the Shenzhen exchange. So Stock Connect plus Shenzhen, lots and lots of pent up buyers. China eases doubts on consumer subsidies with funding assurance. Alibaba movie units pivot, rebrand, bring $2 billion of value gain, i.e. not priced into the stock either. Alibaba updates open source Qwen 3 models to support AI deployment on Apple devices. QXO offers to buy building materials firm GMS for $5 billion. I'm telling you, ladies and gentlemen, do not sleep on QXO. I know it's up some 70-something% since we put it out. I think we've got $13.10 or whatever. It's probably going to take a breather at some point because it's up so much in such a short period of time. But you look a handful of years out, this is somewhere between 80 and 100 and probably more. So that one, some of them take longer, some of them happen quicker. That one happened quicker than expected. The housing market is finally buyer friendly as more sellers slash prices. Here's where you can find a deal. Senate passes stablecoin bill in the big win for crypto industry. That's going to create $2 trillion in demand for treasuries, compressed yields. PayPal is the 6th largest issuer of stablecoins. That will help them. A lot of great stuff happening. Stablecoins market cap surges to record high as U.S. Senate bill passes bill. Fed announces meeting to discuss easing bank leverage rules. This is what I talked about with the SLR with Bowman. When is that meeting? June 25th. So the game is on, ladies and gentlemen. Fed officials hold rates again. Still see 2 cuts before year end, according to the summary of economic projections and Chair Powell's predictions. Dollar slump is the worst since 1980s. Don't expect a quick rebound. That's from Barron's. U.S. exceptionalism in markets is diminished, but far from dead. And I think that's the key thing, is in markets. It's just a reversion. It means nothing about our exceptionalism as a nation. We are the best. We're going to continue to be the best because we get the best from everywhere in the world. It is a melting pot of the best ideas and the best people from all over the world in one place. By the way, if that's true, that they sold 70,000 of the $5 million passports, that is insanity, 300-something billion dollars into the treasury with rich people that'll create jobs. We're gonna, I like the fact that Trump backed off on the people who've been working here for a while, is key because, we need immigrants. There's no question. We need immigrants. Let's find a way to fast track it so more people can come in at all levels, not just at $5 million, but poor, hungry, honest people that want to work hard. We should be letting in by the boatload, not just people with $5 million checks. But they've got to be legal and they've got to be vetted. And maybe there's some common ground in the middle of the road where we can do that, and maybe some penalty for people who've been here illegally, but that are hardworking, non-criminals, pay some type of upfront tax, and then get to stay or something. But anyway, that's all political stuff. We need population growth to continue our hegemony, and we will get it. Intel brings new engineering leaders to help AI come back. This is really wild. You saw the stock up yesterday. Srinivasan Iyengar, Jean Didier Alagrushi, and Shailendra Desai. Okay, none of these 3 are Irishmen. Okay, we need immigrants, said the half Irishman. So, Lip Bhutan is tapping veterans of Cadence Design Systems. You know the story with Cadence. Super 100-something bag or whatever it was when he ran it. Apple and Google, all these guys have huge chip development experience. This is going to be the biggest shock. Energy stocks have had a mixed start to 2025. Natural gas is hot and oil is not. We agree, which is why we've sat on our hands on the oil and just gone crazy on the, by the way, range. Okay. This week, Range Resources, there's one that took longer. But again, if you're patient with these things, I think I've told the story. We bought it at $11 in 2018. It immediately shot up to, we determined intrinsic value was around 60, proved and unproved reserves. Immediately shot to 18. We thought we were geniuses. COVID came, it shot down to $1.10. Or something like that. We backed up the truck, bought as much as we could possibly get, brought our basis down to 410. I think it got to over 41. So it's a 10 bagger in 7 years. Okay. So the first 3 years, it was a bad, quote unquote, if you're early, you're wrong, bad investment. That's just the stupidest nonsense from people who don't do fundamental research. And now it's, it's a 10 bagger. And then you got the Comstock, which is already almost a 4 bagger. So if you know what you own, sooner or later, in the short term, the market is a voting machine based on emotion. In the long term, it's a weighing machine based on fundamentals. If you master understanding, knowing what you own in the fundamentals, like we cover here every week, and you're patient and you don't run on leverage, or any material leverage, there's nothing you can't accomplish, is really what it comes down to. Trend followers stumble into one of their worst years ever. world's smallest violin. Global EV sales rise in May as China hits 2025 peak row motion. That's going to help our Albemarle. And then speaking of which, it plays out in cycle stock market and sentiment results. Bank of America Fund Manager Survey update. We put the summary out on Tuesday. 222 managers running 587 billion AUM. Here are the top 5 points. Opinion follows trend. 54% of managers now expect international stocks to be the best performing over the next 5 years. You couldn't give away an international stock in Q4 when we were pounding the table. Managers are now the most underweight the US dollar. They've been since 20 years. What was the narrative last year? King dollar. Materials and energy remain unloved with managers net 26% underweight. Energy up from last month's record low allocation and 15% underweight materials. There's your Comstock and Albemarle just getting started. 4 of the doomsday recession expectations we saw in April have collapsed, reversing from 42% of managers saying global recession was likely to now a net 36% saying it is unlikely. Trapped bears continue to fuel the pain trade to the upside. And 5, managers are 28% net overweight emerging market equities. How you like that? 28% overweight emerging market equities, up from last month's net 11% and the highest allocation since August 2023. Here's Albemarle. Each week we try to cover 1 to 2 companies we've discussed in previous podcasts, vidcasts, and or own for clients, including personally. So you can see here, free cash flow is recovering, but still lagging. Prices doing exactly what it should based on that. Our favorite theme heading into 2025 was the last shall be first, with healthcare and materials as our top 2 sectors. Both had been left for dead after posting anemic returns in 2024, but earnings for the 2 were expected to recover handsomely in 2025. Healthcare was projected to grow by 20.7, materials by 18.9, both ranking among the top 4 overall sectors. 6 months into the year, healthcare has largely held up, now projected to deliver 14.5% earnings growth and ranked 3rd overall. Materials stumbled out of the gates, partially on the tariffs, took it on the chin from tariffs, with earnings growth now expected to be 7.8%. But as they say, being too early is indistinguishable from being wrong. That's exactly how this one has played out so far, with the materials recovery looking more like a 2026 story. And if we zoom out, the delay in the recovery could end up being more like a blessing in disguise. That's because our number 1 pick for the theme is Albemarle, a position that at the time wasn't large enough yet because the price had run away from us. We don't buy up, and we're hoping to get a second bite at the apple. Luckily, we've gotten the opportunity served on a silver platter to size in accordingly. Albemarle is the world's largest and lowest cost lithium producer. The roller coaster story of lithium over the past 5 years goes something like this. Demand went through the roof in 2021 and through 2022 as the EV and renewables boom took off in full force. Automakers were scaling production and stockpiling lithium, all while supply was heavily constrained from years of underinvestment and logistical bottlenecks. This perfect storm sent prices up more than 8x, reaching all-time highs of north of 80,000 per metric ton, and Albemarle was minting more cash than they knew what to do with. But the high prices quickly brought a wave of new supply. Small-scale producers in China, many fully subsidized, flooded the market and created massive supply glut. Lithium prices came crashing down, and Albemarle stock fell with them, down more than 80% to where it is today. The good news for Albemarle is that, as we mentioned, they are the largest and lowest cost producer worldwide. This has allowed them to cut operating costs and capex and pretty much sit on their hands and wait for cyclically low lithium prices to recover. Meanwhile, the longer prices stay in the pain zone, the more low quality marginal producers will get taken out on a stretcher. To put this into context, Albemarle management estimates that 40% of global current lithium capacity is at or below break even, only with 1/3 of that supply having come offline so far. This should continue to support Albemarle and lithium prices from the supply side, with analysts expecting the supply glut to shrink and largely be gone by 2026. So, with supply starting to dry up and marginal producers coming offline, the focus now shifts to the other side of the equation, demand. And what becomes immediately clear is that demand has never been the issue for lithium. It has gone up and to the right with no signs of slowing, with consensus still calling for 15 to 20% CAGR over the next decade. Meanwhile, all the noise about slowing EV growth in North America, still up 17% year on year, has created a catharsis among investors, but that completely misses the point. The reality is that North America accounts for just 10% of global EV sales. The real story is China, which makes up more than 60% of the market. It's a government subsidized market, and the government will not stop when it has its mind set on something, and just posted a 41% growth in the first quarter. Meanwhile, while everyone stays focused on the EV narrative, they are missing what may be the biggest shift happening under the surface: data centers and stationary storage. Just a few years ago, this segment was expected to make up around 5% of total lithium demand. Today, projections are closer to 30%. A few weeks ago, Ken Hoffman, shout out, by the way, to Brad Kay, client in OC, who sent me this. Ken Hoffman is an expert in lithium and battery materials, formerly at McKinsey, laid out the case for a lithium recovery. He sees the bottom in 2025 and a gradual recovery starting in 2026, prices reaching $15,000 to $20,000 per metric ton by year end. While the market obsesses over the temporary supply glut, Hoffman's thesis is built on something you won't hear anyone else: underappreciated demand. He projects global demand could reach 6 to 10 million metric tons by 2035. We've been talking about it going from 1.2 to 3.2. So if this happens, this thing could be a 5-bagger, but let's just be realistic here, or conservative. Again, demand in 2024 was about 1.2 million, and Albemarle's high-end forecast for 2030 is 3.3. That's in line with our forecast. This guy's talking double or triple that, and we see a 3-bagger just on the conservative estimates. If that scenario plays out, Albemarle isn't just a double, it's a multi-bagger. Now on to Albemarle earnings. Here's everything you need to know following the Q1 report. You can go through this step by step. Break-even free cash flow in 2025. That's key in trough prices, the fact that they can be break-even. By the way, this is a dividend aristocrat. They've raised the dividend every single year for over 30 years. That's going to continue to happen. You can lock in a very low basis so that as the dividend, you'll lock in whatever it is, 2.5% or 3%, whatever it is now. But even as the price goes up, the dividend yield on your basis is going to keep going up as they keep increasing the dividend. And then if you reinvest it, you can really compound money. Anyway, here are the 10 key points. Through April, management achieved 90% run rate against the midpoint of their $350 million cost and productivity savings program. More importantly, they've identified additional opportunities to reach the high end of $300 to $400 million range with potential for even more upside. Adjusted EBITDA margins in Q1 came in at 25%, up 400 basis points year on year in a trough cycle. This is unbelievable, with SG&A costs down over 20% as the cost savings program continues to bear fruit. 3, in light of cyclically low prices, management continues to cut back on CapEx with full year 2025 expectations of $700 to $800 million, down more than 50% year on year. This comes down from an already low base in 2024 that was reduced by over $450 million compared to 2023's $2.1 billion of CapEx. The long-term mid-cycle CapEx target remains around 6% of revenues. Cash from operations in Q1 totaled $545 million, including a $350 million customer prepayment, resulting in an operating cash flow conversion of 204%. Excluding the prepayment, conversion still came in at 73% above the long-term average of 60 or 70%, bringing full year 2025 expectations to north of 80%. 5, not only did management maintain their full year 2025 outlook, they also reiterated their expectation of break-even free cash flow for the year after delivering slightly positive free cash flow in Q1, with positive free cash flow expected during 2026. 6, the direct impact of tariffs is expected to be minimal, totaling $30 to $40 million for the full year. Before any mitigations, this is largely due to Albemarle's global footprint, with most lithium production sold directly to Asia and the critical mineral exemptions that are currently in place. Management has mitigations underway to significantly reduce their overall realized impact, including increased sales to lower tariff countries and optimizing supply chains. 7, management has estimated that 40% of the current global lithium capacity is at or below break even, with only a third of that supply having come offline, aka the longer prices remain in the pain zone, the more low-quality marginal producers will get taken out on a stretcher. 8, for the full year, lithium demand is expected to grow between 15 to 40%, with management currently forecasting growth around the mid-20% range. Long-term demand growth remains strong, with lithium demand projected to more than 2x by 2030 from 1.2 million metric tons in 2024 and up to 3.3 million metric tons, growing at a near 20% CAGR. Despite the headline noise, global EV demand continues to remain strong, up 34% year on year. Strong sales in China continue to lead the way up 41% year on year, and remain over 60% of the total global EV market. Long-term demand expectations remain intact, with EV market penetration expected to exceed ICE by the end of the decade, reaching about 54% global penetration. And 10, stationary storage continues to be one of the main drivers for lithium. The market is expected to grow at 20 to 30% CAGR through 2030, growing from 192 in 2024 to between 600 and 970 in 2030. Earnings call highlights you can go through at hedgefundtips.com. And then here's an article from Morningstar with a fair value. Lithium prices will rebound, then remain well above the marginal cost of production through at least the remainder of the decade, leading to excess profits and return on invested capital for Albemarle. Therefore, they have a $200 fair value on the stock, down from $225. The stock is trading at about $60 right now, so they're looking at a three-bagger plus in a handful of years or less. I think it's going to be more, and we're excited about it. So that's that. Moving along, earnings, top 30 weights of financials, last 60 days revised up 0.19% and 0.06% for 2025. What was one of those companies that got revised up was PayPal, baby. How you like that? Healthcare, top 30 weights, revisions last 60 days, down 3% and 2.85% in 2025 and 2026. Respectively. Let's see what were the biggest downs. Lilly, so probably a lot of these GLP-1s, okay, if you remember that. Let's see here. Cigna, probably a little UNH in there. All right, moving along. Retail sales were down. So, Powell has all the cover to act if he wants to. He doesn't want to because he doesn't understand history. He thinks this is the 70s. It says no resemblance to the 70s, but it'll be what it'll be. Trump will start name dropping, doing some trial bombs for a shadow Fed. Everyone will ignore Powell, will be a lame duck till the end of his term, and people will start to price in 200 basis points of cuts for next May in the coming 2 quarters. Earnings growth, low bar for Q2. Expectations are 4.9% earnings growth, down from 9.3% at the end of March, which sets up the stage for earnings beat and a continuation of the rally through midsummer before we get into the normal chop sideways stuff, August, September, October, prior to year-end rally. With that said, the podcast is over. Now we're going to move on to the Ask Me Anything questions. For those of you who get a lot of value from questions from our audience as we go through individual companies. The rest of you, we'll see you next week, same time, different place. I'll be in New York and Connecticut. So Ivor Barry, if you had a gun to your head, what new stock would you add to the portfolio and why? That's like asking me what's my favorite kid. The answer is you can't take it discreetly. We always take it in the context of our 8 to 12 companies that we want to be concentrated at the moment. And our new clients will find out which ones they are on July 1st. So that's that. Our existing clients already know which ones they are. Nate Kelsey, your podcasts have been extremely educational, and I've looked forward to the weekly updates for more than 2 years now. Big, beautiful bill currently under consideration includes a roll-off of solar tax credit. Okay, so he's asking about Enphase. I've been asked about Enphase every week for the last 2 years. I've continued to say no. It's continued to go lower. These stocks did do well under Trump 1.0. So counterintuitively, and energy stocks did not, and PH. The problem is I think all their balance sheets are toast, and if there's going to be no subsidies from the government, I mean, that's the big thing. That's why Elon got pissed, is because the bill guts all the climate spend. And so they've got some free cash flow. How's this balance sheet? $1.6 billion of cash, $1.2 billion of debt. Yeah, I mean, the big problem with this is, it was a 300 bagger off the lows. It is a broken growth stock. It's going to take an awfully long time to build a new set of shareholders. And looking at the financials, I think it looks okay, but I'm not inclined to do anything with this at the moment, but I am inclined to start to do some work on it. So I'll leave it there, but nothing really exciting about that. York Bourgeois. Hope your week has been going well. I had a question regarding your approach of enterprise value versus equity value, wondering which you valued more, especially I think that's not, it's not even a framework way to think about it. You always have to consider enterprise value, debt plus equity minus cash, because that's total capital invested, and you have to consider the total return on invested capital. I do look at equity value. I tend to favor that a little bit more as an equity investor, but I also analyze it on the basis of enterprise value because I want to calculate total capital and the return on total capital. So I don't think it's relevant to getting the outcome that's going to give you alpha, but I do think you need to do both, is the answer to your question. Kyler Johnson. I don't touch this one. Focusrite ticker tune. Let's take a look at that. Right, it's not a US stock, I guess. TUNE. Yeah, it's British stock. All right, cool. Wow, complete round trip. Let's see. Huh. I mean, this is a tiny business. What do they do for, let's see, 208 million. All right, what do they actually do? Development, manufacturing, market, professional audio and electric music products. This is a niche, tiny little small cap business. Yeah, I just don't know the business. I mean, you really have to understand what is their moat, what's their competitive advantage. Is this the go-to? Like, no one really competes with them for these products. Are they that good? Why is growth slowed so much? What's the plan to reaccelerate? Or does every guitar player already have one of these synthesizers? But I do like the turnaround story. Looks interesting for sure. I would just have to have confidence in the product and understanding the moat, which I don't think I'm ever going to have a real edge on. But if you do, know what you own, I think you got something here. You just really have to go through all the public filings and the last maybe 8 conference calls, see what management has said, see what they've done, see what they're promising, how are they going to turn around, how are they going to reaccelerate growth, and you might have something here. So I think Kyler Johnson is on to something and finding a niche opportunity there that may turn out to be something good for him. So good work. Let's move to the next one. Mark Calloway. Thanks for all you do. I sing your praises to anyone who will listen, and they all thank me for it later. Well, thank you for that. By the way, very grateful for your support and tuning in each week. If you're getting value, which I know so many of you are from the beautiful notes that you send in and testimonials, which you can find on the website and on the YouTube every week on the videos, all I can ask is, one, at the very least, go to YouTube and write a comment and give your feedback. That helps push it up. The more people that view this, the longer we're going to do it for non-clients. Like, subscribe to the channel. Just go to YouTube, type in the search bar Hedge Fund Tips. The Hedge Fund Tip channel will come up. And then the best compliment you could pay me, if you're not a client or not able to do business with us, is to share it with one person you like and loves markets and would really benefit from this framework and help them make a lot of money. So grateful for you doing that. And I invite the rest of you, if you want to give back, that's one great way to do it. So his question is, do you think Coinbase entering the payment market for e-commerce and Robinhood, rumored to do so in the fall, will affect PayPal? PayPal has such a moat at this point that the amount of stock, they're going to buy in 20% of the company. They are the 6th largest stablecoin. I'm watching that part of the business. They have margin recovery. Alex Chris, what he created at Intuit, running 50% of the revenues, multi-bagger. I'd bet on Alex Chris way before I bet on either of these two CEOs, as much as the success that they've had. Coinbase, I think, is going to get commoditized at some point. Brokerages, everyone's super excited about Robinhood, and it's had a good run, and Vlad seems to be a good CEO, but all of that gets the margins just get eroded. The brokerage business has never been a durable competitive moat that doesn't get competed away over time. Robinhood and Coinbase will be no different. So yeah, I continue to like PayPal over those. Sagar Kanakaya, curious your preference about Intel over AMD. Very simple. How many fabs does AMD have in Arizona or Ohio? And that's all you need to know, is that the government, whether they like Intel or hate Intel, needs Intel. And we need to produce chips in the US. Yes, Taiwan Semiconductor has fabs, but they're going to need unlimited numbers. And Intel has the 5-year runway. This will be one of the greatest hockey stick stories, from most hated to most loved, in the shortest period of time. When it turns, it's going to turn all at once. AMD, there's too much downside. I understand what the upside is, but the downside is material, and there's nothing to back them up, because there's nothing they have that their customers can't find another solution elsewhere. Whereas Intel, once their fabs are rolling, they're going to have a US duopoly with TSMC. So that's that. But you'll notice that a number of these questions, just note the names and what was in the headlines this week. You have to just keep that in mind, ladies and gentlemen. That's Brandon coming in. Thank you. Paul Gertz. Paul Gertz. Hey, Paul. Could you look at Clorox? Yeah, we've looked at this one. We do like this one. I'm not sold on the CEO. She's kind of been futzing around, FUTZ, for too long. So I would like to see a replacement of the CEO, if that hasn't already happened. But yeah, this is a long-term compounder with a moat. That's just been a little bit mismanaged of late. So free cash flow, I mean, look, the revenues haven't begun to recover. Margins are recovering. I think this one is probably fine here. If you could get it at $100 or $110, that would be even better. But I think for the long term, This one's generally going to be okay. And I like the thing. It's one that keeps popping up that I'm not doing anything with because it's not an easy double in a reasonable amount of time. But I think you'll get nice returns and pretty handsome dividend while you wait, if I'm not mistaken. Let me just see here. 4% dividend yield while you wait. My guess, let's see what they've been doing with the dividend. I can't even get in. All right. I think they've been increasing it quite a bit over time, so that's a good one. Or an okay one, rather. Okay, Alan's sending me the bull bear. Thank you. Hope this email finds you well. Wanted to chat about the jobs numbers, retirees, blah, blah, blah. Frank, none of that's going to make us any money. We deal with companies. That's all just macro noise. Simon Stasianis, Icon Enterprises, no thank you. Where there's smoke, there might be fire. Absolute legend, but there was too much intercompany financial chicanery going. I'm not interested, even though I love what he's done over the years. I love his framework. That one makes me a little nervous. Stumbled upon Zeta Global. Let's take a look, Lucas. Wow. All right, so the first thing I want to figure out is why the margins have come down so much. Let's take a look at, all right, so the revenues are growing like a weed. I mean, what? The share count's gone from 31 million to 186 million. So congratulations. They continue. So, okay. So revenues have grown 3x. The share count has grown 6x. So the share count's grown twice the pace of the revenue, and the business. What's cash flow done? 4x. Balance sheet's probably clean. Yeah, I do not like that kind of growth in the share count. Marketing automation. Yeah. No, I just don't think. I mean, I have no confidence in knowing they're not going to take the share count to 700 million. So I don't like these type of managements. So not for me. John H. Loving the podcast. Pitney Bowes, no. There's a lot of people promoting Pitney Bowes, and the story's changed, and it looks better. Blah blah blah. It's not for me. And it's already moved anyway, so you're kind of late. Let's take a look at the story here. We've done this one before. I don't like it. I know the business has changed. I know they've got all this story about how it's going to be better. They have this every 5 years, and every 5 years it's the exact same result. Pops up, insiders sell stock, reverts back. Not for me. Eric C. Love listening to your podcast. Do you think Merck is doing more fears of the 2 million products having competition? Generics not doing well. I keep looking at Merck and doing nothing, but I think it's probably ready. It just hasn't come in enough for me to get super interested, but it's on my watch list. I'd be a pass here. I need it to come down more before I'd get interested, and it may not do so. Tom, love the podcast. What small caps? Jack, we've already covered like Comstock. We've covered Cooper Standard. We have a lot of small caps. We own Canada Goose, a tiny position. So all the small caps we've covered. Otherwise, just buy a small cap ETF. Opinion, not advice. But you got to get exposure to small caps and just don't think about it for the next 3 to 5 years. Matt Del Priori. I covered this somewhat recently, but have you thought about Nike? Yes, I've thought about it, and I have VF Corp as a better risk reward. I mean, Nike is probably going to take longer than everyone thinks. Nike could be a double or triple. I think it's going to take 5 years. I think VF Corp can be a multi-bagger in 3 or less. So for that reason, I think Nike's good here. We're just not going to own it at the moment. We higher and better use. RAF, Goldburn, Safe Store in the UK. SAFE.L. All right, cut in half. Free cash flow peaked 3 years ago, pretty much along with revenues. Return on capital has continued to erode. Margins have continued to erode. What do? They are self-storage group, 209 stores. Yeah, I have no edge on this because I don't know what the supply-demand situation is on that. You'd really have to study the industry to have an informed opinion on that. Let me just see something here. Again, this is a broken growth stock, but it may be close. Let's just take a look. I'm sure there's $1 billion of debt. It's supported by the assets, but you're cutting it. What's happening with the free cash flow? Yeah, it's pretty steady. I don't really have an edge on that business in Europe. So for that reason, I'd probably pass, but it might be worth you doing more work if you think there's an opportunity there. Let's just see here. Yeah, just you might have something. It's not something that I would look at, but I appreciate you sending it in. Joshua Kaplan, Sprouts Farmers Market. This has always been a bad business, but let's see what it looks like now. Looks like it's recovering. SFM. Wow. Wow. This is absolutely, what I can tell you is supermarkets are never a good business. So you have a run here, you're expanding, everything looks good. Eventually you're going to hit a brick wall and you're going to crash, just like you see in the TikTok memes where the 18-wheeler, tests like a Land Rover, tests a Tesla, and they all smash into the wall like an accordion. That's what happens when you own grocery store stocks. So I would just avoid it like the plague. It's almost as bad as airlines, except airlines, you can buy cyclical troughs if their balance sheets are okay and make a quick double or triple. But supermarkets are just bad news. So I wouldn't touch it. James Dieters, unless you think that you're going to get a lot of inflation and their inventory value goes up, but that's a sucker's game. I wouldn't play it. Tom, appreciate your wise counsel/opinion. Thanks for all you do. Wondering if you'd have time to talk to Jeff Edwards about the China tease that he gave on the previous interview. Yeah, look, everything he needed to say was on there. The business is great. Be patient. Stop looking at price on a day-to-day basis. You'll be fine. And by the way, you're already up 4x, so chillax. Sorry it's not 10x in 2 minutes, but thank you for the question. Udit. Thanks for all the great insights for your podcast. You're just amazing. Thank you very much, Ud. That's very nice. Safe doubles or triples. Yeah, Diageo and Crown Castle, absolutely fine. Terry S. and we own both of them. Thank you for your content and hosting the podcast. Love it. Question, how can I learn to analyze and see markets like you do? 20 years in the business, listen to the podcast every week, get your CFA, I think is key if you're young. Warren Buffett's annual letters, must-read books is Intelligent Investor by Ben Graham for starters. And we've covered like lists of like 10 or 20 books in the past, but that's the starting point. And then go from there. Enjoy the journey. You'll find out after reading The Intelligent Investor whether this is what you should do with your life. If you're just joining because you think it's going to be a great way to make money, I would go into another business, be an entrepreneur. If you're joining because it's what you want to do 24/7, then you might have a chance after 10 or 20 years to get an edge and find your own unique style that can deliver value for your clients. John Martin, Omega Flex, gas piping in residential construction. OFLX. This business is low quality. OFLX and very, very small. Margins are holding up. Let me just see here. Pretty good balance sheet. I mean, the revenues haven't gone anywhere in 6 years. They're actually down. So I just don't know what the growth story is from a stock perspective. Share count's been pretty steady. I mean, this is the kind of business that $20 million of free cash flow. %4 dividend yield. They don't expect growth either, paying out that kind of dividend. So you're paying, enterprise value is $282 million for $20 million of free cash flow for a flattish business that shows no signs of growth. Yeah, it has definitely operating leverage relative to housing recovery. But I want to start to understand the turnaround story from management before I even look at it. I think, I mean, this could easily go to 10 before it starts to recover. So management better start to show some signs of recovery, because if it's going to continue to have flat to negative revenue and financials, there's no telling how low it can go. It had its run. It's a broken stock. Here we are 5 years later. It fits with the theme, but it's too small of a business that there's no moat. It's not like it was huge and it got hit, but everyone still needs their products. This is like $100 million business. It's like if it ceased to exist tomorrow, it wouldn't affect anyone. If like Cooper Standard ceased to exist, it would hurt a lot of OEMs. It would like delay their lines, all the value add that they've done. So I don't see why this business needs to exist, but at some price, it makes sense. I just don't know if this is the price yet. And you'd have to listen to 4 to 8 conference calls and really understand why and how they believe they can turn this around. And it better be unassailable. Terry S., big follower of Tom and his podcast. Love the analyst. This guy wants to build a website for me. Terry, send a mock-up to info@hedgefundtips.com. I'll take a look at it. As long as it doesn't affect the functionality, I'm open-minded. But at the end of the day, there's an old saying, big hat, no cattle, fancy website, no substance. I have an ugly website, tons of substance. I kind of like to keep it that way. If you look at Berkshire Hathaway's website, it looks like it was done by a 3-year-old 30 years ago, and they've done just fine. So I'm open-minded, but not a top priority unless you completely wow me. And thank you for the offer. Emil Bustamante. Any plans to get some exposure to rapidly growing commercial space industry? Already have it through Boeing. Dave Berger. Thoughts on Boston Beer Company? Hard pass. Mark Dory. 212 retail UK brokerage. I don't like the brokerage business at all, even as excited as everyone is about Robinhood and crypto and all that stuff. It's not what I say. You didn't send me a ticker, so I'm going to pass on this one. I just don't like the brokerage business generally. Cork Snyder. Talked about Ray Dalio a bit. Why his countries go broke. He sees America, blah, blah, blah. When in the 2030s, we begin to have issues due to population issues. Yeah, look, Cork, here's what I can tell you. When the music is playing, get up and dance. I think the music is going to be playing at least to 2030 and beyond. And if Dalio's pessimistic about the 2030s, I tend to agree. But by then, we'll have made so much money and cashed out and be sitting in cash and defensive in the early 2030s when the population falls off in the U.S., that we'll be buying bargains like it's going out of style from probably 2034 to 2040, and God willing, and make an absolute killing on beyond that. But for now, like that's so far off. I don't, Dalio predicting the 2030s are going to be bad. I tend to agree with him, but what precedes that is a booming 2020s, and that's at least 5 to 7 years more of nonstop money making. Ride the bull while you got it, and there's all the factors are lined up for things to be super amazingly strong till the early 2030s, and then after that, then Dalio might be right, and we might have a problem, but we'll deal with that then. I wouldn't worry about it now, unless you're trying to sell a book. Jimmy Jones, Winstock. Wish your family blessings. Thank you. Wish your family blessings. Winstock. I think you're okay here, but this is just like this thing just trades in a range back and forth. You're probably at the low end of the range. It's a good business, best in class, but you're not going to make a ton of money on this. Yeah, go for it. It's okay. It's a trade. It's not one that I want to hold for a while, and I don't think you're going to get a double off it. Next. Question on Crown Castle. Just be patient with this, Theo. This is just an interest rate play. It's going to work. They have a moat. You don't want to overcomplicate things with that. And then got Paul. And that's it. We'll be back next week. Same time, different place. In the meantime, make it a great one. Bye for now. Thanks for tuning in.